Thank you very much, Ifoma. Ifoma has done a very concise but robust update on global markets and on domestic markets. And I'm sure as investors, our thought right now would be where down the tunnel is the light, or when would market rebound. And one critical thing we need to do as investors at this point, in the midst of the noise, in the midst of the volatility, is to step back and reevaluate our reasons and principles for investing. The reason why this is important is because it helps us ensure that we're still in line with achieving our investment goals or objectives in whatever line or whatever space they could be. I would also like to state that we're in interesting times, we're in unprecedented times, and the truth be told, one has to be very strategic and disciplined in whatever decisions we are making. What it means is that markets, and this can be proven with various historical data, markets has over time been able to rebound from whatever form of crisis it may be. Could it be political crisis? Could it be economic crisis? And could it be public health pandemics or epidemics like we've seen? For example, I know in 2003, the SARS outbreak that happened, it was just took about 3 quarters before market rebounded and was up back. I think it lost about 2% and was back again to about 10%, which was where GDP growth were during that period. So the economy picked up after, of course, a vaccine was found or the pandemic was controlled. Now, I just want us to quickly just go through a number of things, which are the things that you normally ask an investor when they're ready to invest. We had earlier laid emphasis on the need to ensure that we're strategic and focused. We're also disciplined, and we also need to also understand that it's a game of weight, right? It's a game of long-term investing, especially when you have a long-term horizon. When we also need to ensure that whatever decisions we make in whatever asset classes we're investing in, we stick to sound security selection, laying emphasis on safety of assets. So just a quick essential questions, and I'll just like you to make a mental note as we go through. I would only focus on, I think, every other thing is important there: your age, investment objective, time horizon, liquidity needs, and trying to match your asset liability. But I'll just lay more emphasis on the risk tolerance, the liquidity needs, and asset liability match. Now, the importance of the risk tolerance is that it helps you understand as an investor what end of the risk spectrum, that is the risk profile, I should be investing in. We understand that some market is a game of weight. Some market, depending on your time horizon, you have to invest based on your liquidity needs. So the risk tolerance could be broken down into different levels. If you are low risk, or you call it below average risk. If you are above average, which is probably you have a long time horizon and you can actually wait the game, you have patient capital and you have cash that you can deploy to make provisions for your liquidity needs. Or you're an investor that is just in between. There's always an asset class readily available for investors to invest in based on your risk tolerance. When it then comes to liquidity needs, which is very, very important, this has to do with you being able to fund whatever withdrawals, liabilities, or even maintaining your lifestyle. Right? So what that talks to is you need to make a mental note of what do I need to make provisions for? Could it be monthly? Could it be quarterly? Could it be annually? So let's make a mental note of that. Then the asset liability match is very simple. What it just says is I have a target in the next 5 years, for example. I'm going to retire. I need to be able to fund my lifestyle, or I need to be able to pay my kids' school fees. So you have a target and you work towards it. The risk you face as an investor not being able to do an asset liability match is that you might then not be able to achieve your investment goals or your objective, because you might then be facing some degree of reinvestment risk, which is the risk of you investing at lower rates or investing at lower prices, as the case may be. Now, I'm sure you've all taken a mental note of that, and we're going to delve into the various asset classes that can feed all these essential questions we've gone through. In Nigeria, basically, we know we have just very few asset classes or investment outlets. We have equities, we have fixed income, we have currency and real estate. Ifoma has said a number of things on real estate, so I probably will not lay too much emphasis on that, but I would come and focus more, of course, because it's largely illiquid also. That's the real estate segment. And most in Nigeria, the rental yield is pretty low, right? So when you compare it to other asset classes, other asset classes might seem more attractive, despite the fact that there are always opportunities in the real estate segment, especially in an environment where economic is expected to be a recession. right? So what it means that there will always be opportunities in that segment, and it's something we can look to later with our wealth advisors. Coming to the fixed income segment, a lot of things has happened in this period, and it's all because of what the CBN did. What the CBN did was to, segregate the market. So we had the market prior to now. So I'll focus on the first topmost part of the graph, which is red. Sometimes in October last year, 2019, what the CBN did was to exclude non-bank financial institutions from investing in OMO market, right? The CBN's actions was right, because that is what every other market is. That is what OMO papers are meant for. But prior to then, investors are taking advantage of it, and we're then focusing on the liquidity management or the challenges the CBN was facing. But now things have changed. You realize that at that period, that is the topmost part, as like Q3 2019, before the CBN took action, the yield curve was more or less flat. We saw some secondary market activities. That is, people were trading and buying this instrument. But after the CBN took the action, the blue bottom curve, dark blue, which seems sort of choppy, what it meant was market dynamics then changed drastically. Rates dropped significantly. So currently now a 1-year bill would return an average of effective yield, which is interest rate of about 4.16%, while 1-year instrument down the curve, as in the longer dated instrument, maximum as of today, maximum of about 11.5%. But there's something the yield curve tells us, which is what we analysts are now looking at. Ifeoma has talked about the fundamentals and what we expect the triggers that we'll be looking at to drive this. But here we'll be focusing on what we expect, which is based on the factors she has mentioned and also based on what the yield curve says. The yield curve, basically, when it's upward sloping, indicates where you expect future interest rates to trade. And what it means is that you expect future interest rates at the long end, which is longer termed instrument, you expect them to be higher. We can then buttress this expectation with the factors that we've talked about, which is the pressures we're facing on revenue, the need for the government to fund recurrent expenditure. And also remember that we've always said there's a clause to it, as Ifeoma stated, and that clause is that as long as they can raise multilateral debt, then we might not see that significant uptick in yields. But the basic fundamentals should still apply, which are the risks that we expect and what the yield curve is telling us. Now, the strategy for this is simple. Because you expect an increase in interest rate, what you should then be doing is investing at the short end to medium end of the curve. What that means is this: I should be looking at a 3-month, 1 month to about 5 years, 3 to 5 years average, right? And the reason why I'll be doing this is because I expect that interest rates are expected to go up. So the different investment out there that you can consider are money market funds and fixed income funds. The reason why you're doing this, or why you should do this, is because you expect an increase in interest rates. What it means is that with this instrument that I invest in, money market and fixed income fund, I can earn competitive returns above what a normal fixed deposit instrument would earn me, and I can also make provisions for my liquidity needs as they come or as they arise. We then go into the next asset class, which is equities. Equities are it's a very unique asset class. But what the equity market has shown, if you look at the topmost part of the graph, shows that at every point in time, the market has been able to rebound or stabilize from different economic shocks or shocks that it has witnessed. You might then look at the outlier, which happened in 2007, 2008. During that period, what we found was that it was a period wherein there was a free market and lots of things were not managed, right? And during this period, a lot of things were not managed, which had to do with financial market regulations and rules. The market was, the capital market operators, took advantage of the opportunity. We saw that upside. It was a global market financial crisis and it affected every market. But I think after that, different regulators have put in different actions to ensure that the markets are regulated. Looking at, I would say in the last decade, we've probably witnessed about 3 to 5 years in the market and experienced bulls. But I'll just talk about some few periods, right? In 2017, for example, market was up by about 42%. In 2016, was down by about 6%. 2016 was peculiar, almost close to what we are moving to right now. And what happened during the period was that if you even look at the graph, you realize that the levels are almost that part. The markets has picked up as of today, but as of March 20th, March 30th, and as of 2016, the ASI was trading around the same levels. But I would say that prices have still not dipped to those levels. So in 2016, it was an interesting period. We had a recession, all prices were low. So investors factored all this in and started selling down the market. But eventually, markets picked up in 2017 and was up by 42%. In 2013, also similar thing happened. 2011, market was down 16%. Prices were low, and new yellows were redefined. Investors that were buying the dip and were ready to wait the tide, of course, reaped the benefit in 2 consecutive years, in 2012 and 2013. Basically, this just tells us that, the equity market has opportunities for investors to take, and it's those investors that are patient, that are able to buy the dip, that can take advantage of this. I would also then delve quickly into the dividend yield, and I'll link this to fixed income instruments. And the reason is this: dividend yields currently are attractive, and the ASI, the dividend yield of the ASI is about 7.3%, and is the highest we've seen in the last decade. And the reason why this is so is very simple, and why it is attractive is very simple, because what has happened is that, prices have been depressed, earnings have improved, corporate governance has improved. A lot of things has happened that has changed the dynamics of the numbers, right? And I'll just mention a few names that we have that have not closed their books, that the dividend yield are still attractive compared to a 1-year treasury bill that will give you. So 1-year treasury bills today is doing 4.16%, while we have some names that have not, in the likes of Dangote Cement, MTN, Nigerian Breweries, and Nestle, they have not declared dividend. They've not close their books yet, forgive me, but they've declared dividends. So there's still that opportunity. Then in a nutshell, I'll just wrap up this asset class and just bring you back to today. I stated that as of March 31st, the market was down negative 20%. People were beginning to buy the lows. They were buying the dip. New yellows were redefined. 5 to 10 yellows were being redefined, right? And what it meant was that there were opportunities for investors to take. Investors that took those positions then have actually reap the benefit, because what we've seen in the last 1 week is an uptick. Prices have moved, so they've done, dependent on the names you're exposed to, they've returned an average of about 5 to 10% capital appreciation. So this just tells you, and as we speak today, the market is slightly pulling back again, meaning that prices are coming down again slightly. So there are always opportunities in this asset class. What we just need to focus on as investors is, what is my risk appetite here? Do I have capital that I'm ready to deploy maybe in the next 1 year, right? Are these prices attractive? Do I find them attractive? As long as there's value in those names, what would advise investors is to begin to buy in tranches. There would always be opportunities. New yellows would be redefined, and those that buy the dip would always reap the benefits of waiting in this asset class. I would then move straight to the last asset class that I'm sure everybody's interested to know what's going to happen, and that is currency. Now, the thing is, to be very honest, this asset class is currently giving us opportunities that are really attractive. Prices have pulled back significantly, and it's largely into the global economic crisis, right? So what we find right now as we speak is that the Nigerian Euro bonds are trading at levels almost at par with what the Nigerian sovereign are, the Naira denominated bonds are trading. And what has just happened is that people have seen the risk in Nigerian economy, and they are like, okay, we need to price in this risk. They've sold the instruments, markets and prices have pulled back, and that's created opportunities for investors to expose their portfolio or investing. Another thing we also need to take note is the trajectory of where we expect the Naira to trade. Beyond now, in the next 2 to 3 years, right? So what we estimate, based on the fact that Nigeria just needs to, diversify its income, its revenue streams, is that we might probably continue to see currency pressures until the market is actually allowed a proper free float. Now, we just take a quick look at this graph, right? At the bottom part, which says that shows all prices, the dark blue line, and the top part that shows the light blue line, you see that they are moving in opposite directions. It's just showing that there's a negative correlation. So as prices come down, all prices come down, you might then begin to see currency pressure. So in light of what I've said, which is based on the expectation for currency, the expectation for currency is that in the next 3 to, even from now to the next, let's say, short-term view of 1 to 2 years, the Nigerian currency will probably remain under pressure, and the factors are clear, but the risks are eminent. As long as we don't diversify our income stream and ensure that we improve on export and all the other things, it means that there would always be pressure. Now the question is, would there be another technical devaluation? Ifeoma has focused on what we expect, which I will just quickly round up in a nutshell, which is highly dependent on if we are able to raise the multilateral loans. And if yes, we are able to raise those loans, it will provide some degree of buffer for reserves, and the CBN might not actually take actions again immediately. What has happened in this asset class is the CBN in 2017 and even up until now, they just bring in different policies, different guidelines, administrative measures to try to manage the currency, the pressure on the currency. And I think at a point in time, they'll probably just need to give way and let the Naira trade freely, but would all be dependent on what the CBN's actions are. So now, I think from our point of view, we expect that there's likely to be another depreciation or technical devaluation, as you may call it. What we then need to do as investors is to then take a two-pronged approach. I can invest in this asset class because I want to take advantage of exchange rate movement. And I can also invest in this asset class because I have dollar liabilities I need to fund. So we need to weigh a balance between the two. And you then need to then focus on the need to tick some certain boxes, like managing liquidity needs. You need to ensure that you invest in instruments, probably in funds that will give you that liquidity allowance, right? You also need to invest in funds that would, in instruments or funds that would help you reduce concentration risk. And also you have to invest in line with your risk appetite. So this asset class is an asset class that is an opportunity to take advantage of right now. And the key triggers we need to look at in this asset class, to guide it, there will be a depreciation or a technical devaluation, as it may be, will be oil prices, the impact on external reserves, and the CBN's actions to drive rates. But one important thing that the CBN has done clearly is to ensure that the markets, the direct impact of reserves, that is of currency on interest rates, has changed. Like we talked earlier, the reason why this has happened is because of the action CBN took in September. But it's an interesting asset class, and we should focus on those factors that I mentioned: managing liquidity needs, reducing concentration risk, and investing in line with your risk appetite. Wrapping it all up, it's interesting how markets are. We're in a period where you expect a lot of volatility, and it's investors that are able to buy the dip, that are able to tarry the tide and wait it out, that reap the benefits. Most times, it is not, you don't always get it right in buying the lows. Neither can you always time the peak wherein to sell. But there are always opportunities, and you need to monitor the markets and begin to take positions gradually. Begin to buy the names as long as you find them as undervalued, as long as you find value in them, as long as you see that the credit risk on whatever instrument you're investing is low. There would always be opportunities, and we need to begin to invest in tranches in line with our risk appetite. We should always remember also that as investors, there would always be opportunities, and investors that are the fastest fingers, basically, they're the ones that reap the benefit of all of this. Thank you very much for your time. Our team of financial advisors are always available to guide you through and help you achieve your investment goals. We'll then move straight into the question and answer segment.